In terms of this bounce that we've seen for markets, do you think it's bounced too far, too fast?
Hey, Wolf, great to see you and good morning. That's a great question. I think part of the why we've seen this bounce is, we're seeing a little bit of the market pricing in more easing a policy from the Fed, and I think that's, might be too early on that, and so that's where you might get too far too fast. But one good thing during this rally is we saw in second quarter's earnings, stayed pat, and we didn't see a rolling over of earnings for, a lot of companies. There were strong numbers that came out, and I think that's a reason why you're seeing a lot of this relief rally going forward. And I think, seeing what happens in September and what is set forth in September is going to be a big for investors to decide if we're going to be pushing higher.
In terms, Patrick, of where valuations are at and various comparisons, one pointed out to me yesterday, which is that the dividend yield of the S&P 500 is back to where it was in March, i.e. it's fallen again as equities have rallied, yet the 10-year yield, the kind of comparable alternative, has soared. Does that suggest that equities are overvalued again?
Certainly not. I think to put it in the context, we started the year at 21.5 times with a lot of excesses in areas like technology and growth stocks. And what happened is interest rates rose and credit spreads widened, and that really removed a lot of the excess, bringing things back in line with long-term averages. And with the profit growth as strong as it is, we're seeing something around 10% in the current quarter, and it's going to remain healthy in the couple quarters ahead of us here. We don't think valuations look extended, particularly with the excesses being removed from technology, growth stocks, in areas where investors typically look for the strong return. So absolutely not. We don't see valuations extended here.
And clearly this earnings season has been at least less bad than feared, Patrick. But from here, you forecast that the next couple of quarters will see earnings upgrades, not downgrades?
Well, we think growth remains robust. And I think what's important is everyone's focused on the pace of deceleration in economic data. But I think what that does is it takes away from the fact that we're still seeing a very strong economic backdrop from a nominal basis. And companies, inflation is pricing power to companies. So we're going to see revenues remain strong, running in the high double digits. And we're going to see profits remain they're going to hold in. I mean, there's a little bit of margin pressure, let's call it what it is, but we're not seeing anything which is going to result in this significant rollover, which I think was feared as people were forecasting the deceleration to turn into a recession. And we just do not see that in the current data.
Delano, in terms of the earnings we saw yesterday on the consumer side, obviously more to come today. Do you think that suggests that the U.S. consumer will support the economy and avoid a recession coming through, or is that still going to arrive?
I think that's the hope right now, is that we're still seeing, spending, obviously, different baskets, and it's kind of bifurcated between, family income. But as you mentioned, I think the big concern is that we're seeing that the consumer is taking on, more debt, and those debt levels are increasing. And I think that's one metric for investors to watch, because if that falls through, then we may be in a situation where we're pushing to lower lows, as we'll see companies, obviously start to change their earning projections on that. So, we're really focused on that data, because it's going to have a very interesting pull for what's going forward.
And Delano, I mean, if we look at it right now, the S&P 500 at yesterday's close is about 11% from its record highs. Remarkable that we're back at that levels. What do you think is more likely in the course of the rest of this year? That we break into record highs once again, or that we retest those June lows?
I think what's likely for us for the rest of the year is there's a key level, that we are looking to break through on the moving average, 200-day moving average. And I think if we break through that, there's a very high possibility that we will break to higher highs, and which is, as you mentioned, remarkable from what we saw year to date earlier this year. So I'm pricing in, there could be priced in that we break through those levels, that we'll potentially see higher highs.
Patrick, is there a risk to your positive outlook that rates continue to go up from the Fed more than expected? If we saw another 75 basis points this year, albeit a little more spread out, would that make you more bearish or not?
Well, so I think the question is, what's the market expecting? And we're expecting or at least the market's expecting a rate of around 3.5 to 3.75 by the time we get to the middle of next year. So the expectation is for a continued ramp in Fed policy, really to fight inflation. Right now, the most recent CPI reading gave hope that we have seen the peak. If it's not the peak now, we are in the process of seeing a peak. So that individual data point isn't necessarily important. But as long as the pace of CPI continues to come down and the Fed begins to remain data dependent on what inflation is doing, I think it gives hope that the market continues to move higher as we begin to match the policy against the decline in inflation. I think that's really key, and that will allow valuations to expand, because valuations suffered as interest rates rose, to your point earlier. But we don't necessarily think that the fear that the Fed is going to crush the cycle and run away ultimately causes a problem here.